Hi, good evening, and welcome to Traders Talk. And this is your host Ming Hon. Yeah, and yes, if this is Tuesday, and yesterday was a good market day or bad market day. Yeah, we will watch. We'll watch shortly as we actually go in to the charts to actually see what happened last week, and also what do we actually expect this week. Yeah, and of course, this basically every Tuesday we're actually going to cover the stock market, the US stock market, to actually also learn a bit more about trading. And of course, this week, we are actually not going to do any trades this week, but basically just go back to some basics about the options trading. Yep. And this week, we will actually cover. What's in a delta? Yeah, delta is one of the Greeks, one of the four main Greeks that we use in options trading. And of course, this is actually one of the core things that you actually go through if you are actually learning how to actually trade options. Yeah, and of course, if you do not know what is delta, and if you do not know what delta is used for and what it represents, then of course stay on for this show so that we can actually go through what we use delta for, and basically how does it help us in becoming better traders, and also to make decisions in our trades. Yeah, okay. So that will cover later towards the day. Okay, so for the first part of the show, we will actually go through the what is that the markets. Yeah, the markets. How has the market performed last week, and what do we actually expect this week? Yeah. So basically, I think the market has actually been on retracement, right? A retracement, and we have seen that practically almost half of the week last week. Yeah, half of the week last week. And of course, towards Thursday and Friday, we do see some change in the trend. There's some change in the trend, and of course, we have also explained the possibilities of this movement, right? This movement in our show last week. So that's why it's actually important for you guys to actually how to say watch our show every week. So that it's just to actually give you some perspective. What do you actually expect the market to be in the following week, right, or in the current week? And of course, when that thing actually happens, right, you are actually ready. You see, yeah. That is also to plan for your trades, and also to see what kind of things or adjustments that you actually need to do in event that happens. Yeah. So S&P currently is at 4048. Yeah. So it actually went back above the 4,000 mark, right? As we have actually said many times, right? The 4,000 marks is the round figures. The round figures are actually always areas where it's actually a psychological area. 4,000, 4,005, 3,005, yeah. So these are actually areas, psychological areas, and of course, once we actually breach that, right, we tend to actually see the market to be a bit more. The momentum would actually be a bit more towards this level when these kind of levels are actually breached. As you can actually see here, right? Yeah, as you can actually see here, once it actually touches and breach, right, then on that day itself, the momentum for the market that day has actually been quite bullish. In fact, it has actually moved about 1.6% last Friday. Yeah. And what did we mention last week? Anybody could actually recall what did we mention last week? Not recall. Okay, so last week basically we actually one two three four five. Okay, so when we was at the show last week, right? This was actually the candle, right? One two. This was yesterday. One two three four five. Monday, yeah. So this was actually the candle where we said it actually bounced on this level, right? About somewhere around 3950. It actually had a bounce, and of course, this basically we did mention that this was actually a support. This was actually a support, and of course, it did bounce on that day itself. But the subsequent few days, right, it actually had came down, retest this level, retest this 3950 level. It actually went below. for 1 day lah. Then basically on Thursday itself, right, it actually bounced off above this level, and of course once it went above, then it actually was quite bullish for the next 2 days. In fact, yesterday itself, the earlier part of the trading day, right, the trend was still quite strong up until basically it hit close to the upper pivot line, right, where it actually started to dip. It's actually started to dip, and of course, for us, how we did. I mean, I did put in some puts yesterday, but I couldn't I couldn't somewhere around here when it was actually going close to the pivot point, somewhere around here, right? Uh, I did put in some puts, but I couldn't wait. It did not retrace. I couldn't wait, and I went to sleep, and I just put limit orders to exit the trade. And of course, after I woke up maybe about three something to see some of the trades which has been closed off because the market has actually dropped back. So those puts were profitable and even exited the trade. Yeah, so that's why you see yesterday itself, the the candle was somewhat bullish, was somewhat bearish. Sorry, was somewhat bearish. Because it had actually came down towards almost the end of the day. Yeah, and of course the lines which we have actually drawn, right? We have actually drawn a couple of lines here. So this was the 1 year support line, which we always mention, right? 1 year uh, support. Sorry, this was actually the resistance line, and possibly now it can actually become a support. But it did not even touch this level right till now. It is actually still holding off these support lines here. And of course, there is another line above here, which basically can also act as a resistance line, resistance level here. Yeah, before it goes even to the higher levels like 4160, right? So there may be possibility some resistance above at these areas. And of course, this week itself, what do we actually expect on the economic news, right? This week, I don't think there is much besides the unemployment, right? Unemployment, which actually comes in on Thursday. Yeah, unemployment claims Thursday, and of course on Friday itself, there is actually the unemployment change, and also no, the non-farm employment change. And also the unemployment rate. Yeah. So these are also somewhat key things that the Fed actually looks at. And we have said many times that we need to have bad economic news for the market to to actually so-called rally. Yeah. Yeah. And why is that? Of course, these metrics, of course, what the Fed has said, they want to inflict pain on the economy. And once they inflict pain on the economy, the inflation and all this would actually come down. And as a result of that, they can actually stop the tightening of increasing interest rate, right? So that is what we have to actually put in your mind. But anyway, these are basically just how to say possible economic data which will actually influence the overall macro things. And of course, sometimes itself, even bad news, the market can actually how to say, the market can actually drop itself, right? Because the other side of it is that the fear of recession, right? And bad economy would lead to actually recession, and that is the other side of it. So it actually sometimes contradicts itself. And of course, this kind of news, we only look at it, and from there on, right, we still go back to the charts to actually see where the so-called event has impacted the price action of the charts, in particular S&P, right? And where is it actually, whether it's actually holding off support, whether it's actually bouncing off resistance, yeah. whatever news that influence it. Yeah. So these are the levels where we actually always need to actually monitor. Yeah. So yeah, I mean, so where are we headed? Of course, after 2 strong days, right? 2 strong days. I mean, some form of retracement is also okay, and especially towards the end of the week, where we actually expect to have those two economic news on Thursday and Friday, and also this week itself. I think today and tomorrow itself, the Fed chairman is also giving his testimony on what is that, Congress, right? He's actually giving his testimony today and tomorrow. Yeah, Tuesday and Wednesday. So for 2 straight days, he can actually talk and speak, and of course, depending on what he says, that might also influence the market. Yeah. And I think the other week we also covered something on the Fibonacci retracement, right? Yeah, Fibonacci retracement. And of course, this is also another indicator which we actually use to spot for resistance, support and resistance level. And of course, if we actually move on all the way to December till the high, right? The current big retracement, right? Actually directly fell on 61.8%, which is actually a very strong level of what is that, support, right? Support. It actually touched it exactly at that level, and basically after that, the market had actually rallied for 1 2, considering yesterday a partial three consecutive days once it actually touch that level. Yep. So this is also one thing which we tend to use to look at support and resistance level. Yep. Okay, so yeah, so that's SPX, and of course, I think as we mentioned, basically, possibly the market would tend to uh, uh, move around up and down, yeah, just jumping around until it actually gets the next boost to actually either break the high or the lows. I don't think it will actually go back so fast to the lows, right? To the lows, unless at the next at next Fed rate hike, they actually say that they are going to actually raise the rates by 50 basis points instead of 25 basis point. Then of course that would actually freak the market out, right? Freak the market out, and then the lows. You might see the lows again. Yeah, if basically they still go on the 25 basis points hike in 22nd of May, right, and also the CPI which will come out in 14th of 22nd of March, and 14th of March is the CPI, and of course if CPI is in line and not continuing to be higher than expected, right? Then of course that would actually ease the market a bit to give it a little boost to actually go back higher. Yeah, and of course for the first 2 months of the year, right? 2 months of the year, we had actually already enjoyed this rally. I think about slightly more than 10%. Yeah, although in February we actually dip by 4 or 5%, right? Yeah. In March itself, we actually had quite strong start. Yeah. All right. Okay, so Nasdaq. Okay, I mean, yeah, it's pretty much similar to SPX, right? Where we actually saw it actually bouncing off this support, which is actually at about 11,900 level, and also at the same time the 200 moving average, daily moving average. Yeah, this is the 200 moving average, and of course, moving average is also one indicator which we actually use to identify possible support resistance line. Yeah. So of course, yesterday itself, as I said, basically it lose its momentum. It lost some momentum going up, right? Going up, yeah, it lost some momentum. Yeah, and of course now it's actually in the middle of the so-called range between here and here. Yeah, it's actually in the middle. Yeah, of course, situations like these, strategies, option strategies, which are currently working well, so still neutral strategies. I mean, we have actually put in some iron condors on SPY, which is basically, I mean, since we have put it in maybe about a week plus, less than 2 weeks ago, right? So those kind of positions are actually still profitable. Yeah, I mean, assuming you actually put it in here, right? It came down and then now it actually go back to the same level 2 weeks ago, right? So that's actually good for the trade, because after 2 weeks, basically you are back to where you were in terms of the price, right? In terms of the price, you are back to where you were, but of course, the trade has actually decayed for almost 2 weeks, and that would actually add on to the profits of the trade. Yeah. So strategies like that, as long as it does not move beyond the range, of your trade, right? Your short strikes, right? Then of course that would actually be positive for the trade. Yeah. Okay. And of course, if you are directional, then of course, 1 week, 2 days up, 2 days down, then it would actually be a bit difficult to manage such kind of trades. That's why, if you are directional, once you are profitable, it's good, whether on the downside or whether on the upside, right? It's good for you to actually exit the trade. Otherwise, you see your profits being wiped out, and then of course you need to actually wait for a so-called change in the price, right, of the stock or the market, to actually get back into profit. And of course, one thing which you do not have time in directional trade, you do not have luxury in directional trades, is actually time. Yeah, because options, when options expire, right, expire, then you would not get to benefit from the price move which you are actually expecting. Yeah. Okay. Right. So yeah, I mean, if you have any questions on the market, do post on the chat. Then I will actually answer them if I actually get a chance. Yeah. Okay. And yeah, I mean, the other thing is, of course, our newsletter. Yeah, don't forget to actually read our newsletter, which we cover many things. Of course, the markets, we will also do a revision on the markets in the newsletter. And besides that, sometimes technical technical trainings, or technical information, which basically talks about strategies or additional information which will be beneficial to help you in your trading. Yeah. Okay. The other thing which I forgot to actually cover is on the Hang Seng Index. Yeah, Hang Seng Index. Let me go back. Okay, all right. So the last, I think we spoke about this Hang Seng, we were actually talking about the 20,000 level, right? Basically, that level where we expect again a psychological level, where we actually expect to actually see, yeah, the market to see if it actually holds or not. Yeah, in fact, it actually went down below, went down below. I think all the way maybe to 19,600. Yeah, but of course, subsequent to the release of the manufacturing index, if not mistaken, the price manufacturing index of China last Thursday, if not mistaken, last week, Wednesday or Thursday. Then of course, first of March, I think. Yeah. Then of course, that actually had a 2 months consecutive increase in the price index, right? Then of course that had actually given a very big push for the market to actually go up. Yeah. And I think yes, last weekend itself, the China government or the CCP also had their some meetings, right? Some meetings to actually plan for their growth expectation and whatnot. And of course, After that, I think early in the morning, we did see the Hang Seng to actually spike up by, I think, about 400 or 500 points up. Yeah, 400 or 500 points up, 400 points up. Okay, only for less than an hour, if not mistaken. Yeah, less than an hour before it again gave up, gave up a huge jump of 400 points. Yeah, 400 points. And of course, this is also somewhat not a good sign. You see that it touched this 50 moving average, right? 50 moving average, and then it actually came back down. Yeah. So Hang Seng is also a bit volatile, and let's see if it actually holds on around this level of about 20. Yeah, about 20,400. Yeah, so 20,000, I think it needs to actually hold. Yeah, if it holds, then of course you can actually see the next wave back up. Yeah, on China's side, I think the besides the fighting with the US, right? Besides the fighting with the US, on the economic side, side is actually quite okay, because they have just opened up. Things will actually continue to economy will continue to actually expand and improve. Yeah, I mean, the only downside is that they are constantly fighting with the US, and also the propagandas on the Taiwan side problems, right? So those are actually the more of the political issues that they are actually need to face off with. I mean, US has always nothing to do except to actually poke on other people but themselves, right? Yeah. Okay. So this is Hang Seng. Okay. The other thing I wanted to also highlight is that VIX. Yeah. Remember, VIX is again the what you call the S&P Volatility Index, right? Okay. And of course, you can see that VIX is again coming down to the 18 levels. The 18 levels. And of course, when VIX comes down, the market goes up, right? Yeah, when VIX comes down, the market actually goes up. And of course, when VIX goes up, then the market actually goes down. Yep. So the levels, I mean, it's good. I think when it came down yesterday itself, again, we actually put on a bull call spread on VIX, a bull call spread on VIX. Yep. If you have not read our Quick Bites newsletter, we actually explained that, okay, the levels currently of around 18, right? Around 18 is actually the lows for VIX, for I think yeah, for the year. For the year, it is actually the lows. In fact, it has not come to this low since January 22nd, since basically a year ago. Yeah, since a year ago. And yeah, I mean, because of continuing news every week coming out, CPI data, Fed rate hikes, and all this, then of course, when those events actually comes, the market might be spooked off, or the fear again coming up. Then of course, the VIX would actually spike back up again. Yeah. So whenever we have the chance to actually put on VIX spreads, 18 and 20, yeah, I mean, not too big. 18, that means buy a call, 18 call, and 20, you sell a 20 call, cap it at 20. Yeah, buy a 18 call, sell a 20, and expiry date, basically you can actually choose whichever you feel comfortable. And for us, yesterday's our expiry date, I think it was actually 24th of March. I think 24th of March, just basically two plus 2 days after the Fed rate hike. Yeah, Fed rate hike meeting. Yep. So we put on this for, I think, about 70 cents. Yeah, 70 cents. And of course, if VIX spikes to 20 or above, then of course this 70 cents would actually increase. into profits, and that's the time where you actually exit the trade. Yeah. So don't expect for this kind of trades to actually go up a lot. I mean, if you actually get 30 to, I would say 30 to 50% profits, that is actually good enough. Then you can actually exit the trade, and then basically recycle again the similar trades when the opportunity comes again. Yeah, you see, there was once opportunity, two opportunity, three opportunity, four opportunity, and basically this is over a span of how many days? Just slightly above 2 months, right? So slightly above 2 months. So basically, every 2 or 3 weeks, you would actually have one opportunity to actually enter into a VIX trade when it actually comes back down, yeah, and exit when it actually goes back up again, yeah. Exit when it actually goes back up. Okay. All right. So yep. So that's on the markets, overall markets. Then we would actually now move on to a bit of boring, boring but important stuff. Yeah, boring but important stuff. Huh? Yeah. So back to basics. Back to basics. Okay. Oops. Okay. So I will need to write something on here. Okay, so I'll just put it up here. Draw, draw. Okay. So what's in the delta? Okay, delta. What is the meaning? Okay, most people. I mean, this you could actually just get off Google, right? Basically, delta is rate of change in option price given a $1 change in the underlying stock price. For example, $1 change in say Apple price, right? AAPL, right? Okay, so whichever options you have the options price, right? How much will this option price actually change? How much will it change? Yeah, for example, if $1 change in Apple price goes up by $1, this change in the option price is from how much? Say, let's say from 50 0.5 to maybe 0.6, for example. Yeah, so this is basically the change. Yeah, change in the option price. Yeah, so that is actually what this delta represents. Okay, so what do we actually use delta for? And we actually use delta for a couple of things. Yeah, the couple of things, and of course, more importantly, let me. Why is this crossing over to? Oops. Let me rub this. Why I can't rub this? Let me erase. I draw on this slide, and then all the other slides would show me. Very weird. Very weird. Very weird. Hmm? Okay. Uh, draw. Erase. Hmm. Very weird. Just let me troubleshoot this technical thing first. Anyone can help? Erase. Is this permanent? Okay. Never happened before, yeah? drawing tools, replay ink into text, into shape. Wow, more funny things coming up. Let me stop this for a while. Weird. Okay, okay. Maybe I don't draw. I don't know why. When I draw, it actually sticks there. Maybe I don't draw. I just present. Okay, share screen again. Share screen again. Share. Okay, so now the drawing is actually gone. So I don't know why. Okay, so then, okay, what does this delta represents? Okay, delta represents probability, yeah, probability, and then it also measures traction, and the other one is actually direction. So basically, you just I will actually explain what is this probability, what is this traction, and also direction, and basically how this actually applies into our trade, how this applies into our trade. Okay, so if you actually see delta, and we always actually talk about doing trades and what is actually the probability of a trade going in the money, especially if we are actually selling options. Yeah, especially if we are actually selling options. Okay, so I mean, bear with me because you can't see my cursor, right? Just look to the right side. Okay, I've actually three circles here. You can actually see my small mouse. Okay, you can see my small mouse. Okay, so for example, currently this Apple shares is actually trading at 153, right? And we actually want to sell some puts on Apple. Okay, so you actually go to the options chain. You can actually see April 21st, which is basically 45 days expiry. Then within the chain itself, right, you can actually see that there are actually various prices where you can actually sell a put. So how do you actually decide what at what level you would at what strike price you actually choose to actually sell a put? Okay, then the matrix which we actually always see is actually delta. Okay, delta. And if you move towards the right side of here, you can actually see that there's one thing called delta here, and basically there is actually just a number where at this orange line, basically the strike price is at the money, right, which is basically more or less similar to the stock price, current stock price. Okay, then you can actually see a delta. Let's say here, for example, coming off from 0.37, right, going all the way when the strike price comes smaller, right, from 150 going back to 110, right, then you can actually see that the delta actually goes to 0.01. Yeah, okay, and we always disregard the the decimal point. And basically, when we actually speak about delta, we just disregard that, and basically we just take the two numbers. For example, this 0.37, we just say is 37 delta. Okay, 37 delta, and going back to 110 strike, which has actually a 1 delta. Okay, and how do we decide, and what does this delta represent? Okay, this delta represents the likelihood of that strike price within the expiry date of 45 days here would go in the money. That means the percentage of that strike price going in the money. That means from $153, it will actually drop down to $140. So that is basically what that delta number represents. And if you look at 140 strike, you can actually see 16 delta, right? So what this 16 delta is that there is actually 16% chance that Apple price would actually drop to 140 by 21st of April. By 21st of April. So this is the delta. Of course, the opposite of it would actually be if you're actually selling selling a put, you would not want the price to actually drop to 140. You have a 16% chance of it dropping to 140. Then, of course, on the opposite side of it, so what is the probability of it not going to drop to 140? Then, of course, it's actually the opposite, which is basically 1 minus 16, which is actually 84%. Yeah, 84%. So with this, right, then you can actually determine what kind of probability do you actually want to have when you actually sell a put in Apple. For example, if you actually want to have a very high probability, then you move lower. You actually move lower. You can actually move all the way lower to, let's say, delta of 4. That means there is only a 4% chance that Apple price would actually go to a strike of 125, and you have 95% chance of winning in this trade. Okay, so that is how you actually gauge. And of course, when the delta is actually smaller when you sell a put, right, you have a higher chance. And when you have a higher chance, then of course, what do you need to actually give up? You need to give up on the premium which is actually earned, because you take less risk, right? When you take less risk, then people are not willing to actually pay that much to you. Then the premium which they will actually give you for a 4 delta put is only 31 cents, as opposed to $1.34 if you are actually doing a 16 delta put. Yeah. So the first measure which we actually use for in delta is actually probability in the in the money. Yeah, in the money. If you are selling options. Yeah, selling options. Of course, if you are buying options, then it is actually the other way, going here. Probability of it going to, let's say 160, right, going to 160 is only 35%. 35%. Yeah, if you're buying options. Yeah, so it's actually the other way. Okay, so that's the first metric which you actually have to understand. Okay, then the second metric is actually what delta does is actually it measures traction. Okay, what is traction? To explain traction, maybe you can say that maybe a short person. Okay, a short person have short legs. A short person have short legs, right? So every step that this person walks, right? So what kind of traction, or what kind of length does this person move? Okay, if he has short legs, then the traction or the move on each step is actually small. If this guy is actually long, a 6-footer basketball player, right? So every step it takes, right, then the length of it, the distance of them going is actually further bigger. So the same, we actually use delta as a measure of traction. For example, if you are talking about buying a call, okay, buying a call, and if you actually buy a call with a delta of 12, okay, you see the delta here of 12. So basically, this 12 means that 12 traction is small. Yeah, because for every dollar move in the stock price, the option price will only move by 0.12. Yeah, 0.12. So that is a short guy. This is actually a short guy. Yeah, you're buying into a short guy. So you need to then think, what is your objective to actually buy a call? Do you want to buy a call that moves very fast, that has fast traction, or do you actually want to buy a call that has very low traction, that move very slow? Yeah. So of course, if you move towards here, let's say you buy a 80 delta call, then of course, for every dollar move in the stock price, then your option price would actually increase by 80 cents. Then you actually get more traction. Yeah. So this is actually one which you would prefer to buy because you actually want more traction, right? But of course, the other side of it is that if you want to hire a tall guy, you need to pay them more lah. Because this tall guy eat more, right? So you need to actually pay more. Of course, if you actually want to hire a short guy which actually moves slower, then you can actually pay less. But of course, the probability of you winning in the trade is less because you have less traction. Because don't remember, when you actually do options, you also need to think of time. Yep, you don't have enough time. If you're doing a 45 days, you want to actually go to the finish line or your target price as fast as possible. Yeah, and of course, with that, you actually want to go into a trade with high traction, or with high delta. Yeah. Okay, so that's another thing that we actually decide what we actually use with delta. Okay, then of course the next thing is always direction. Okay, direction. Okay, if you guys know options call and puts, right? Call and puts, yeah. Then of course, if you buy a call, then you actually want the stock price to go up. There's the upward direction. Then of course, if you buy a put, then you actually want the stock price to come down. Then that is actually a downward direction. Okay, so delta is actually similar. Okay, but one thing you got to be mindful of is what kind of options are you getting into. Okay, for example, positive positive delta, if you look on this side, right, generally here is a call, right? And positive delta would mean that you are bullish, you want the direction to actually go up. Yeah, go up. And that is actually positive delta if you are buying in a buying mode of a call. Okay, then of course, if you move the other side, negative delta, a put will have actually negative delta if you are actually buying it. Yeah, if you're actually buying it, yeah, will have a negative delta. And of course, if you change your side as a seller, then of course the delta would actually also change, and don't get confused. Very easy way is using what we learned in mathematics, right? Okay, so for example, you sell a call. You can take selling a call as a negative energy. Negative energy, yeah. So negative energy, you multiply with positive energy, then selling a call would actually have negative delta. Yeah, and then if you sell a put, selling is negative, right? Selling is negative, and if selling a put negative, you multiply by a negative, right? Then you actually get positive delta. Yeah, so selling a put, you get positive delta. Selling a call, you get negative delta. So that is actually a measurement of the direction. Okay, I couldn't draw the thing, yeah, because of the problems. Right? Otherwise, I can actually draw a matrix, and with that matrix, it would actually be quite easy to actually understand the delta direction for buying calls, selling calls, buying puts, selling puts. Yeah. Okay. Yeah. Okay, then the other thing, which of course, once the four metrics you have actually, the three metrics you have actually learned, right? What were the three? Of course, one is a probability get in the money, and then the measurement of traction, and then direction. Okay, so once you actually learn all these things, right, then you can actually use it to apply to your trades. You can actually use this to apply to your trades, and basically some of the examples how we actually use it to apply to trades is that, for example, we use direction. Okay, we use direction to actually hedge, delta direction to actually hedge. Okay, and one thing is delta. Like for example, if you have say 200 Apple shares, right? Okay, 200 Apple shares. Okay, what does this 200 Apple shares represents in delta? What does it represents in delta? If you have actually understood just now, the delta, right, is actually the change in option price $1 change in the stock price, right? So for example, if you have a so-called perfect delta, would be one, right? So $1 change in stock price, $1 change in option price. And what does that actually equate to by having one delta? It actually equates to you having one share, right? Yeah, because the delta is perfect, 1 to 1. So one delta equals to one share. So that is what you need to actually remember. One delta represents one share because of the 1 to 1 change effect. Okay. So for example, 200 Apple shares would actually equate to 200 delta. 200 delta. Okay. Okay. When you actually understand that, then in a scenario where you actually want to hedge your Apple shares, okay, you actually want to hedge your Apple shares. And of course, you might decide, okay, I might want to actually partially hedge it. How do I actually do it? Okay, then you can actually do it by, for example, selling a call, okay, because you have 200 shares, right? Or if you have 200 shares, then you can actually sell calls. You can sell two calls, in fact, okay. But of course, you do not want to sell two calls. You might just want to temporarily hedge a portion of your shares. Then you sell one call at 50 delta. You choose it at the money 50 delta. Then what does that represent? That represents negative 50, right? Because remember earlier, the direction when you actually sell a call, the direction of the delta is negative, yeah, and 50 delta then is negative 50 delta. So when you actually do the math, right, basically from 200 shares, you are actually deducting 50 delta with this call which you sold. And then basically your net delta is 150 delta. Okay, so what does that represent again? That means you have indirectly moved your position from having 200 shares, temporarily hedging it, to become 150 shares. And why would you actually want to do that? Because you expect the share price to come down, right? So if you have 200 shares and the share price comes down, then you will lose more, right? And if you temporarily have less shares, temporarily have less shares by entering into by selling a call to reduce your position of 200 to 150 shares, right? Then basically, if the stock price move down, the downward impact to your value would actually be less. For example, if the share price actually goes down by $20, right? Then your so-called position, right? Your position will actually reduce only by $3,000. Yeah, it's not 20 times by 200, which is 4,000, right? Yeah, because you have actually changed your delta, your total delta in your investment in Apple shares to 150. Yeah, then your impact is only 150 delta times by 20, and your impact is only $3,000 with this down move. So basically, you have hedged, you have actually hedged 50 shares. Yeah, you have actually hedged 50 shares, which the down move would actually not have an effect on these 50 shares because you have temporarily hedged that position, and that position is temporarily taken off your books with this call. Yeah, yeah. So you will only lose 3,000 temporary instead of 4,000. Of course, when the call expires, right? When the call expires out of money because the share price dropped from the current price, right? Then that call would actually expire out of the money. So when that call is gone, right? Then what happens to your Apple shares? Your Apple shares would actually go back to 200 delta, 200 delta, and of course, at that time when the stock price goes up, right? Then you will actually enjoy again the full 1 to 1 movement of the stock price against the share price against your stock. Yeah. Okay, so that is actually how you can use the delta matrix to actually calculate how much you actually want to hedge, and when you do that, basically what is actually your impact towards your investment or your even your total portfolio. You can also use this delta. Yeah, and of course you can also use that means if you have Apple shares, you can also use SPY to hedge. For example, you can also use SPY, which is a totally different thing to actually hedge. Yeah, you can also use that to hedge. Yeah, and you do that by calculating delta. how much you actually want to hedge. Okay. The next one is that, the next one is actually again another scenario where we actually look at so-called what this delta represents when you actually do a trade. For example, if you actually look at here, right, if you actually enter into a call, you buy a call, right, you buy a call at say 160 strike. Okay, that represents a delta of 35. Okay, that represents with a delta of 35. And what does this delta of 35 represents? It represents delta 35 means that you have indirectly deemed holding 35 Apple shares. Yeah, 35 Apple shares. Why 35 Apple shares? Because you remember the first, what is that? The definition of delta. $1 move in stock price is how much movement in the option price. Yeah. So with this, basically, you're talking about holding indirectly 35 options. 35 Apple shares by buying this 160 call at $320. So basically, you are actually paying $320, right, to control 100 shares. Okay. And you can also buy the shares outright by not using options. Yeah, but that would actually cost you $5,200 to buy outright 34 Apple shares at $153. So you actually need to pay $5,200. And the same thing is if the stock, if the what is that? If the share price move by $1, right? If the share price move by $1, then you will actually get $34 increase in your share value. Okay, and the same thing is here. If the stock price move by $1, your option price would also increase by $34. Yeah, so you see the big difference, right? Okay, you pay 320, you still get to actually enjoy Deem holding 34 shares, Deem having a so-called valuation move of $34 by just paying $320 to own it. Yeah, as opposed to having the same position using shares, paying $5,002 to actually get the potential to enjoy this $1 upside to make $34. Yeah, so that basically again shows you, by understanding delta, right, you can actually compare with your current capital, with your amount of so-called risk you actually want to put into a trade. Can you actually use options to actually increase the return on investments? Yeah, you can actually use that to plan and to calculate your trade, whether you want to use options or whether you actually want to buy shares, for example. But of course, the other thing we should actually need to always remember is options are decaying assets. Okay, options are decaying assets. And if you pay $320, and if you do not get this $1 move in fast enough, right, before the options expire, then this $320 will actually go down to zero. As opposed to you paying $5,200, right, to buy Apple shares. If it doesn't go to increase by $1 this month, yeah, you are still holding to this 34 shares at $5,200 which you paid. You can wait for next month for it to actually increase by that $34, yeah, or $1. Yeah, you can actually wait, but not for options. So that is actually the thing which you have to pay for it in order to actually get this better capital, better return on investments. So basically, that is the thing which you actually have to pay for it. Yeah, that's your cost. Yeah, that's a cost. If it doesn't go your way fast enough, then you would actually lose the total money which you actually put in. Yeah, so that is one way where we actually also use delta to plan for capital allocation, return on investments, risk management. Yeah, so this how we actually use it for. Okay, and lastly, delta. we mentioned we can actually use it for hedging. And then the other thing is that delta neutral. Okay, you also have to actually understand the concept of delta neutral. Okay, what is delta neutral? Delta neutral means that you are okay. That means if you are at zero, that means you are actually in the middle. Okay, if the price goes up, then you will be delta positive. If the price goes down, then you will actually be delta negative. This is quite important to actually understand, especially if you are selling options. If you are selling options, yeah, if you're selling options. Remember just now we actually spoke about delta is the probability in the money, okay, and when it is actually zero, right, means that it has zero probability of getting in the money, means that you win, you totally win lah. I mean, you totally win, right? So when you are selling options, right, you want to actually control your trade, right, your trade, to have the lowest delta as possible, yeah. You actually want to control, especially if you are, say for example, if you are doing an iron condor. Okay, you are actually doing an iron condor. I hope you guys know what is actually an iron condor. If you do not know, we have many shows which we have actually covered iron condor. We put it on a newsletter, we put it on TikTok, many examples of iron condor. Say for example, if you're actually doing an iron condor, right? Let me put this. Okay, so for example, if you're doing an iron condor, maybe this time see whether I can write or not. Okay, maybe I do a new one. New blank. Okay, now I can write. Delete this. Oops, you're not okay. I need to unshare this. Okay, unshare this. Stop presentation. Present. Share. Changing a new screen, blank screen. Okay, this one. Okay. So, for example, if you're actually doing an iron condor, right? I mean, an iron condor is basically two spreads, two spreads. Okay, one is a bull put spread, and then the other one is a bull bear call spread. Yeah, so it is made out of two spread. Okay, and basically your risk profile would be something like this. Okay, so this is your short. This is your short call price. This is your short put price. Yeah. Okay, the short call, the short put. Okay, so this is your spread. Okay, so when you actually do an iron condor, right? When you actually enter an iron condor, basically, let's say you do a 20 delta iron condor, 20 delta iron condor. So 20 delta means that the short strikes of the put spread is at 20 delta, and then basically the short call is also at 20 delta. Then you actually do a spread, $3 or $5, doesn't matter. Okay, so you actually, when you actually do that, right, your bull put spread and your bear call spread would actually have a delta. If you actually combine the delta, you add the delta of your bull put spread and your bull call spread, you would actually come out with a delta. And basically this delta would actually be less than 20, right? Maybe let's say put it as 15. Yeah, let's say 15 delta. So on this side you have a positive 15 delta, and this side you have a negative 15 delta. Okay, so when you actually enter into iron condor, more likely than often, you actually start off with a zero delta. You actually start off with a zero delta on the combined trade. Okay, then of course when the stock price move, right, then your delta can actually go up or go down. You can actually go up or go down. Yeah. So of course, the thing which you want to best scenario is of course your delta continue to actually maintain small maintain small. Okay, so when it's actually maintained small, then of course it is actually good for the trade. But of course, when the delta changes to become bigger, then of course it is actually going to go against your trade. Yeah. So with another understanding of trade total trade delta, then you can also quickly see where the risk of your trade is when it's actually moving, whether it is on the upside or whether it's actually on the downside. And of course, if you need to actually do adjustments to the trade, right? How you can actually do adjustments to the trade, to adjust for the delta, Yeah. I mean, for most of the time, iron condo, I don't do any adjustments lah. Yeah, I don't do any adjustments. But of course, if you are doing any other trades, then the delta, yeah, delta which you actually want to have a neutral delta. Then of course, if it goes negative delta or positive delta, then of course that's the time where you actually need to adjust the trade. If it actually goes negative delta, then what you need to do is you need to actually add positive delta to your trade. Yeah, and it can also be a portfolio. It can also be a portfolio where you manage the portfolio in a so-called delta form. That means you convert all your trades into delta, and you can actually see where your portfolio is actually good, whether it is positive delta or negative delta. And when you understand this, and when you see that the market is actually bullish, if you have a portfolio with negative delta, that's when the market goes up, you will see that your so-called portfolio would actually lose a lot of money, because your portfolio is skewed towards having a negative delta. Yeah, negative delta. And to adjust it back to so-called neutral, and we are actually talking more about credit spreads and credit portfolios, yeah, and not debit. Yeah. And of course, when you actually want to adjust it back, then of course you have to add delta into the trade so that it goes back to neutrality. Yeah, neutrality. Yeah. So we are talking about credit spreads, credit portfolios. I mean, selling of options. Yeah, and of course that is a more advanced topic. I'm just covering here just in case any of you guys have already been doing that but doesn't really understand the concept of delta in actually managing your so-called credit portfolios. Yep. So for those new traders out there, how to say, go and research further, or dig up one of our old newsletter to actually learn more about these metrics. Yeah. And of course, what I have actually covered today, if you understand 80% of it, it would already be very useful for you to actually use it for your trading. Yeah. All right. So that's a bit more technical training that I actually want to do today, just to refresh you guys in terms of the basic and core in trading of options, which is actually very important, and not to forget, because sometimes we tend to actually forget after we have traded for a while, right? We tend to actually forget to actually use those metrics and use those measures to actually manage our trade or our portfolio. Yeah. And even going into a trade to decide using Greeks like delta. All right, so there are no comments from you guys, and of course, let's see where the market is right now. A bit overbought with time. The markets today, I think it should be green, right? Yeah. Okay, slightly positive on the futures market. Yeah, and of course, I would say be a bit careful if you are actually directional. If you are actually directional, because the market might reverse back because of the Thursday and Friday economic data coming. So it might pull back a bit to take profits. Remember, I said, yeah, take profits, yeah, because of the 3 bullish days, right? A lot of people would have probably taken profits, and it can actually come down a bit. Yeah. Okay. So trade safe, and have a happy trading week. Don't forget to share and like our show and also our newsletter. If you have not read that, go ahead and subscribe to it. The link is down there, and share to your friends. It's all free, no charges at all, just to help you guys become better traders. Yep. All right. Bye bye.